The retirees who pay the least in taxes aren't spending less. They're just spending in the right order. And getting this right could save you $20,000 in your first year of retirement alone. So in this video, I'm going to show you what actually decides your tax bill in retirement, the hidden tax lifts that cost you thousands the moment you cross them, and the perfect 3-phase spending plan to keep your money away from the government. To start, I need to show you what makes some retirees accidentally trigger tax penalties and Medicare surcharges while others avoid them completely. And it comes down to understanding one concept: visibility. Let's say you need to take out $100,000 to cover expenses. If you take it from an IRA, all $100,000 counts as income on your tax return, so you'd pay taxes on the full amount. But if you take it from a Roth instead, you'd have $0 of income because that withdrawal is tax-free. So even though you're spending the same amount, it's two completely different tax bills. And that's because the IRS can only tax what it can see, and it sees income, not spending. So in retirement, your tax bill is really just how much of your spending you let the government see. Visible income gets taxed, invisible income doesn't. So now that you understand visibility, what makes it so much more critical in retirement? Well, every time you take a withdrawal, you're deciding how much visibility you create. And if you time even one withdrawal poorly, you can accidentally push yourself into a higher tax bracket, spike your Medicare premiums, and more of your Social Security becomes taxable, all from too much visibility at the wrong time. But it's not just about the money you choose to withdraw. Eventually, the government forces money out of your IRAs through RMDs, whether you need it or not. So the question isn't whether that money is coming out of your accounts. It's whether it'll come out strategically on your terms, keeping visibility and taxes low, or reactively on the government's terms, triggering a cascade of tax consequences you never saw coming. So how do you actually control visibility without second-guessing yourself every time you spend $1? Well, it comes down to one simple framework. When you withdraw money, there are two kinds of thresholds you can cross: mile markers and cliffs. And once you understand the difference, you'll know exactly which moments of visibility can cost you thousands and which ones aren't worth losing sleep over. Mile markers are things like tax brackets. They're worth knowing about, but not worth obsessing over. Let's say you're in the 22% bracket and you pull out $1 too much and cross into the 24%. Well, on that $1, you'd pay 24 cents in taxes. Annoying, but certainly not anything worth losing sleep over. But cliffs are a completely different animal. These are things like Medicare IRMAA thresholds, and you need to pay close attention to them. Let's say you're right underneath the Medicare IRMAA threshold and you pull out $1 too much and cross into the first tier. Going just $1 over could cost you and your spouse a total of almost $2,300 in 1 year. So crossing a mile marker might cost you a few pennies, but crossing a cliff could cost you thousands. So when you're close to a cliff, that's when invisible money becomes so valuable. The IRS can't see it, which means you can take out as much as you need without risking crossing over that cliff. So by knowing where these cliffs are and using invisible money when you're close to them, you can enjoy your money without worrying about falling into a tax trap. But the problem is, these cliffs don't all show up at once. Each phase of retirement comes with its own tax cliffs, and most people miss them entirely. So let me show you where these cliffs are across all 3 phases of retirement in the perfect spending plan to stay on the right side of them. And to do this, we're going to use Ben and Kathy as an example. They're retiring this year at 63, and they need $100,000 a year to cover spending. So phase 1 is before 65. And this is where retirees can leave $20,000 of tax savings on the table each year without even realizing it. When you retire before 65, most companies only offer continuation of health insurance for 18 months. And sometimes it may not even be worth taking because it can be incredibly expensive. So to get coverage, you can go to healthcare.gov. Let's start by looking at plans if Ben and Kathy's income was $84,600. And I know that sounds like a random number, but stick with me. If their income was exactly $84,600, they'd qualify for a tax credit of $1,621 per month, or almost $20,000 per year towards the cost of their insurance. But before we get too excited, let's go back and add just one more dollar to their income and make it $84,601. All of a sudden, that $1 of additional income makes the entire $20,000 tax credit vanish. That's because this is a cliff system. The government sets the cutoff at 400% of the federal poverty line. And in 2026, that number lands at $84,600, which means for many early retirees, keeping their income under that number may be one of the single biggest tax saving opportunities in all of retirement. Now let's go back to Ben and Kathy so I can show you the best way for them to generate the $100,000 they need and still keep this tax credit. If they took the $100,000 from their IRA, all of it would show up as income, meaning they'd cross the cliff and lose that $20,000 credit. But does that mean they should avoid their IRA altogether? Well, in 2026, Ben and Kathy's standard deduction is $32,200, which means they can withdraw that amount from their IRA without paying any taxes. So even though they need to keep their income low, avoiding their IRA altogether would cause them to miss out on this opportunity. So to take advantage, they take the first $32,200 from their IRAs. Then, for the remaining $67,800, they have a couple options. One would be to take it from their Roth. The entire withdrawal would be invisible to the IRS, and they'd stay well below the cliff. But there's actually another way they can pull the remaining money at a 0% tax rate while staying under the cliff and leaving their Roth untouched. In a taxable brokerage account, you only pay tax on the gains, not on the money you originally put in. So let's say 25% of Ben and Kathy's balance is what they contributed, and 75% is growth. Only the 75% from growth is taxable. So if they took the remaining $67,800 from here, that would mean 75% or $50,850 of this shows up as income. The other 25% is return of what they originally put in, money the IRS can't see when calculating their income. And if the investments they sell have been held over a year, they'd be taxed at long-term capital gains rates, which can be as low as 0%. So when you combine these two income sources, the IRS would see $32,200 from their IRA and $50,850 from the taxable account, $83,050 total. That keeps them just below the cliff at $84,600 and saves them nearly $20,000 on their health insurance. So in a single year, they create three separate tax wins. $32,200 withdrawn from their IRA, completely tax-free. $50,850 of investment gains realized at a 0% tax rate, and nearly $20,000 saved on health insurance premiums. So the order in phase one is simple. IRA up to the standard deduction, then taxable account to stay under the healthcare cliff, then Roth if you need it. Next comes phase two of retirement, roughly age 65 to 75. And in this phase, there are two cliffs you need to watch out for. In 2026, if your income is $218,000 or below, you pay the standard Medicare premiums. But if you cross that line to just $218,001, Medicare premiums can suddenly jump by almost $2,300 per year for a married couple. And that's just the first Medicare cliff. There are additional thresholds that keep increasing your premiums as your income gets higher and higher. So the first and most important cliff to watch for is the Medicare IRMAA surcharge. The second cliff is Social Security taxation. Each time your income crosses a threshold, your benefits go from 0% taxable to 50% to 85%. And for a married couple, that upper cliff hits at just $44,000 of combined income. So for Ben and Kathy, how can we maximize their income strategically without accidentally triggering one of these penalties? Well, remember, they only need $100,000 to cover their spending. So they'll stay well under the Medicare cliff at $218,000. But the Social Security cliff is a different story. That $100,000 is much higher than the $44,000 that makes Social Security 85% taxable. So avoiding this cliff may not be realistic, but that's okay, because the real opportunity is what they can still do with all that room underneath the Medicare cliff. For Ben and Kathy, this phase creates something incredibly valuable, a low-income valley. Their income is lower than it was while they were working and lower than it will be later once RMDs kick in, which means right now they're likely sitting in the 12% or 22% bracket, a rate they may never see again. So in that gap, they can do Roth conversions. They're choosing to pay taxes at a 12% or 22% rate today instead of at 24 or 32% later, which means if they can move $500,000 throughout this phase at a 10% lower tax rate, that's $50,000 saved in taxes. And that might sound like a lot to move, but let me show you exactly how they can do this without crossing the Medicare cliff. First, they need to cover their $100,000 of expenses. But the more visible income they create doing it, the less room they have under the Medicare cliff for Roth conversions. So the goal is to cover spending while keeping visible income as low as possible. And that's where the taxable account comes in. Spending from this account first helps keep income low, because only the gains portion counts as visible income. Then once the taxable account is spent down, they'd switch to IRA withdrawals to cover their spending. And on top of their IRA withdrawals, they'll also have Social Security starting during this phase. But the sooner they claim Social Security, the sooner it starts taking up room in that low-income valley. So by delaying it, even by a few years, can meaningfully widen that conversion window. Then, once they've got their spending covered, they'd use any remaining room under the Medicare cliff to do Roth conversions. even if they're taking the full $100,000 from their IRA, they'd still have $118,000 of room under the Medicare cliff to convert. And because they have all that room, they could easily move tens of thousands into a Roth each year. So by knowing where the cliff is and using this low value to convert, they can lock in lower tax rates now and protect themselves from higher ones later. Then comes phase 3 of retirement, roughly age 75 and on. In phase 3, there aren't any new cliffs. The important change is that RMDs start forcing money out of your IRAs whether you need it or not. And that money stacks on top of Social Security and any other income you have. So the income that used to fit comfortably under the cliffs can start spilling over them. So how can Ben and Kathy protect themselves from that? Well, the more money they moved into a Roth before RMDs kicked in, the smaller those required distributions are, which means less forced visibility and less risk of crossing those cliffs. But even with a solid conversion strategy, there's another tool that can save them from being forced to cross a cliff. Let's say their RMD is $50,000. That $50,000 counts as visible income and could push them over a cliff. But if they take $30,000 of it and send it directly to charity, only $20,000 of their RMD shows up as income. At age 70 and a half, the government starts allowing QCDs or qualified charitable distributions. This allows you to take money from your IRA and send it directly to charity. And because that money never touches your hands, it never becomes visible to the government. So it doesn't trigger Medicare surcharges or push more Social Security into taxation and still counts towards satisfying the RMD requirement. So if they're charitably inclined, a QCD doesn't just save them from a $2,300 Medicare surcharge. It gives them one more way to control visibility even when the government starts forcing money out. But in this phase, sometimes even a well-executed strategy isn't enough. Because if one spouse passes away, the government switches the rules on you. The survivor goes from filing taxes jointly to filing as a single. And every bracket and cliff they've been managing gets cut in half. The Medicare cliff that was at $218,000, now it's at $109,000. But the problem is the income doesn't get cut in half. The surviving spouse keeps the higher of the two Social Security benefits, and RMDs stay roughly the same. But all of that income now has to fit in half the space. This is what's called the widow's trap. The same income that kept them safely under every cliff can suddenly push the surviving spouse over them. So in the middle of dealing with the grief of losing your spouse, the government starts stealing more of your savings. But you don't have to let this happen. And this is exactly where the invisible money becomes so valuable. Taking money from a Roth doesn't count towards any of these cliffs and brackets that just got cut in half. So the Roth money Ben and Kathy built up through phases 1 and 2 isn't just a tax saving tool. It's the safety net that protects whichever one of them is left. So with all that in mind, here's how Ben and Kathy's spending plan works in phase 3. They have forced income coming in from both Social Security and RMDs, so they start by using that. And if this combination is pushing them toward a cliff, QCDs let them redirect part of that RMD to charity without it ever becoming visible. Then for any spending needs beyond what's already coming in, they'd use Roth withdrawals. This lets them cover spending without triggering any of the cliffs, which becomes even more critical if one of them is left filing as a single. So for Ben and Kathy, what can getting this 3-phase spending plan right actually amount to? Well, let's go off of the $100,000 per year of spending. By having the right plan, they could very easily save 10% of this or $10,000 each year, just by avoiding cliffs and paying taxes at lower rates. And over a 30-year retirement, that adds up to $300,000, money that could have covered 3 years of their retirement spending. So that's why getting this right could be one of the most important things you do. But knowing how to spend tax efficiently is only half the battle. Even retirees with the perfect plan still struggle to actually spend their money because they're worried they're one market crash away from losing it all. So to see the data that will make you stop worrying about investing in just 7 minutes, check out this next video.